Hello traders, and welcome to today's webinar. It's going to be a continuation of last week's webinar. And last week we introduced the technical indicator Bollinger Bands. So we have a lot of new people joining us this week. Thank you guys for all coming. This is great. And once again, I have an inbox full of requests from new joiners and people who joined us in the last weeks for me to do a review, to start with a review and cover the material that we've already gone over. So that's how we're going to begin. And by the end of the session, we're going to introduce you to stochastic oscillator and give you a nice little short-term trading strategy. So we began 3 weeks ago by describing technical analysis as a trading tool used to evaluate assets and attempt to forecast their future movement by analyzing statistics gathered from trading activity, such as price movement and volume. We mentioned that unlike fundamental analysts who attempt to evaluate an asset's true intrinsic value, technical analysts focus on charts of price movements and various analytical tools to help evaluate an asset's strength or weakness and forecast future price change. We discussed how technical analysts believe past trading activity and price changes of an asset are better indicators of an asset's likely future price movements than the true intrinsic value of the asset. So since past trading activity is a great indicator, that's also how we're going to study it, is by going back in time to see how indicators gave us certain messages and what happened in the market thereafter. So here we are back on NetDanya, and we're looking at Japanese candlestick charts. Japanese candlestick chart, again, is a combination of a line chart and a bar chart showing price movement over time. So we see that we have two different types of candles here, the blues and the reds. And each candle has two different parts, a solid part, a solid body is what we would call it, and then spikes up above and below. So let's start talking about, first of all, this blue candle. So these blue candles, they show price increase over a specified period of time. Right now, that specified period of time is 1 hour because I have selected 1H. I can make each bar equal to 1 minute, 5 minutes, 10, 15, 30, 1 hour, 2, 4, 8 hours, day, week, or month. So right now, each of these candles is 1 hour in time. So this one candle right here, first of all, we're looking at the body. So the bottom of the body shows us the first price of that specified time period, the opening price, and then the closing price would be the top of that body, the last price for that hour. Now the spikes above and below show the price range for that hour. So within the hour, the price went as low as here and as high as here, but it started here and ended here. So now if we go over to the red candles, they show a price decrease over a specified time period. So the spikes are the same. They show the highest and lowest price, but the body is different now. Now the top of the body is the opening or first price of the period, and the bottom of the body would be the last or closing price for that period. So we know that price on these charts is separated by pips, a mere fraction of a penny, but also the difference between winning and losing trade. So that is one of the things we discussed in part one. Right after that, we went on to talk about support and resistance. So just a brief review of support and resistance, which of course refer to price levels on a chart that tend to act as barriers from preventing the price of an asset from getting pushed in a certain direction. So we practiced drawing a few of these. Let's see what we got. Okay, so if we go back in time, we need to use our imaginations now to pretend we were back in December. Now, when I was back in December, this was a point of interest to me. Why? Because it was a strong downtrend that came to a brief halt, and I decided to draw a support line there. How did I draw that support line? Well, I come here to lines, click add line, and then go horizontal freehand. And that changes your mouse into a drawing tool. and you can draw your line anywhere you like on that chart. So that's how I drew this line. Okay, so then after I drew this line, I wanted to look back just out of curiosity, and when I did, I saw that at a different time in the past, the price came down to a similar point and then took a reversal. So now this indicates strength to me in this support line. So now what I would be doing is, say we drew the support line back in December 23rd, and now we're just waiting. We're waiting for one of two things to happen. Well, we want to see the price come back down to that support line where one of two things will happen. One thing that could happen is it could bounce and reverse upwards, is what we're hoping for. But another thing that could happen is it could break through that support line. So right now, we're not trading if the line comes close to the support line. We want to see it actually hit that support line. Okay, and here, this last red candle, it hits that support line. So this would be an indication for us to take a call position. And for this particular strategy, we would use the rule of Quattro, meaning we would take our time scale up here and multiply it by 4. So we're on a day chart now. That means we would be trading for 4 days. So if we took a 4-day call here, let's see what would happen for us. 1, 2, 3, 4. The price would have ended up here. That's well clear of the where we took our trade, so that would have been a winning position. So let's see if there are any other opportunities with this support line. And we do want to see it actually hit the line. Okay, we do have a hit here. Okay, so we could take another 4-day call. And you do see 1, 2, 3, 4, and the price is much higher. And again, another hit here, another 4-day call. And this one actually would have been very, very close call. It could have been a win, it could have been a loss, but it's a perfect time for me to tell you folks out there that none of these strategies are 100% guaranteed. They're not always going to win, but they do win a high percentage of the time, which is why we go through the trouble of teaching these strategies. Okay, so here we have a breakthrough. Now what this is telling me is the downward momentum is very strong enough to break through this barrier. So when we're just starting out as beginners, we are going to forego this opportunity and not take a trade. And if we look, we see that it was a false alarm. We could have taken our call position there, but you know what they say, better safe than sorry. So let's continue. And I'm waiting to see it hit the line. All right, so that probably would have appeared to me at the time of the trade to be a breakthrough, and I probably wouldn't have taken that trade, and for good reason. You can see the price fall right through, and now we have this breakthrough. Now, again, another breakthrough. So I would not take a call position here. Let's see if I can show you why. Look at that. The price continues to fall down, and that's what we're afraid of when we see such a breakthrough. Okay, so we are avoiding these situations, and we want to just trade when the price bounces off the line. So that's support. Let's see if we can bring up a resistance example. Okay, so here we are. We had a nice, strong uptrend, and at the top of it, after that uptrend, we had 2 periods that ended around the same point. So this was a great point for me to draw my resistance line. And it's actually brought down a little lower than the top, and I'll tell you why that is. It's because when I look back in time, I can see that the price comes nowhere near that line, so I could be waiting for a very long time. So I brought that line down just a little bit, and we're going to do the same thing that we did last time. Okay, we're waiting for the price to approach that line. We see that it's close to the line, but we want to see it hit the line. Okay, and we have a hit right here. This is where we could take a put position in this place. And again, we're on a day chart, so it would be a 4-day put. And we'll see what happens if we take that 4-day put right here. Okay, and we do see the price fall thereafter. Let's see if there's just one more example, and then we'll go to RSI. I have a lot to cover with you guys today, so sorry for the rush. Maybe just one more example here. Okay. Here we have a bounce, so that's a perfect place to take another 4-day put. And you do see the price fall thereafter. Maybe there's just one more example here. I'm not sure. No. Okay, so we're going to, after support and resistance in part 1, we finalized our discussion with an explanation of RSI, the Relative Strength Index. The RSI, once again, is a technical momentum indicator that compares the magnitude of recent gains to recent losses in an attempt to determine overbought or oversold conditions of an asset. And last week we compared the words overbought and oversold to overpriced and underpriced. So here's a little review of how we applied that RSI. Okay, so USD CHF. Now I already added this RSI here, but for those of you who want to add an RSI, you would come over here to Studies. Opens up a pop-up window, and you'd come over here to RSI and click Add, and OK. All right, so now you can see the RSI is on a scale from 0 to 100, with 50 is what we would call fairly priced, and we have two specific levels in mind: 30, which would tell us an asset's oversold, or 70 or above, which would tell us an asset is overbought. So now we're going to look here. So we have our eyes on this chart, but we also have our eyes down here. Now we're going to rewind and see if we can spot some opportunities that were given to us with this RSI. And I guess we could start right here. Okay, so what we want to see with the RSI is it drop below 30, and then we wait. We wait for the RSI to come back above the 30, and that's where we would take a call position on this candle right here. And we're using the rule of Quattro again. So we're on a 10-minute chart, so this would be a 40-minute trade. So if we took a call position at that candle, you do see the price increase thereafter. And let's see if there is another example of this. And I'm just looking down here, waiting to see the price hit the 30. We might not see that here. Let's see. Fast forward. Maybe not the best example. Let's continue. Okay. Here, we see the price drop below 30, and we're waiting to see it cross back above the 30 line. Notice that I've drawn a line here. That's just a visual aid to help me spot the 30. Okay, so now I'm waiting for the RSI to come back above the 30. And here it does in that next candle right here. So that's where we could take a 40-minute call. And if we took a 40-minute call at that candle, okay, so this particular situation would have been close to a tie or possibly a loss. Another reminder that these examples are not 100% foolproof. Okay, so we have another cross below the 30 over here, and we want to see a cross back above the 30. Perfect opportunity for us to hedge the last losing position. So right between these two candles is where we would have taken another 40-minute call, and the price does increase thereafter. That would have been a winning trade for us. And let's see if we have one more example. Okay, so we are below the 30 now. Let's see if we get above that 30. All right, and here it happens. So this RSI is telling us to take a 40-minute call right here. But 1, 2, 3, 4, yeah, would have been a winner. Close one, but a winner for sure. Okay, and one last example for the RSI 30. It crosses below the 30 here. Okay, and we want to see it cross back above the 30, and that happens in this candle. Right around the bottom is where we would take that 40-minute call. And another, yeah, this one would not have gone our way. We can see that the RSI was incorrect this time. So let's look at RSI in the other direction, 70. So let's bring up a different asset now. GBP USD. Okay, so let's rewind and see what we can find with the GBP. All right, so say we were watching this asset again. Now this time we're watching for the RSI to go above 70, okay, and then drop below the 70. So here we see the cross above 70, and here it drops below, right between these two candles, right in this area. So that would tell us we're now on a 2-hour chart now. We're using the rule of Quattro. It's telling us to take an 8-hour put. So that would be 4 candles. Let's see what happens if we took a put there. Oh, a huge drop, so the RSI definitely came through for us there. And let's see if there are any other examples. Yes, the price is crossing above 70 here and drops below right in this area, in these two candles right here is where we would take another 8-hour put. And we took it up here, 1, 2, 3, 4, the price is well lower. Let's see if there are any more examples. Okay, we have the cross over here, and it crosses right back down. So in this candle, right around this area, we would have taken another 8-hour put. Okay, and that you can see that that is well in the money. So maybe one more example, and then we'll move on to the next thing. I'm looking down here, waiting for my RSI to go above 70. Went close there, but not quite. All right, no, didn't quite touch the 70. And maybe that will be our last example. Let's find out. It's coming back up, no. Okay, one last cross above. Let's see if this will work for us. So right between these two candles, the RSI crosses back below the 70. Perfect place to place that 8-hour put. And you do see the price fall there after 4 candles later. We're much lower. All right, so that is what we discussed in part 1. Part 2, we moved on to moving averages. Let's see here. Okay, so I'm just getting set up here. So a moving average is simply a way to smooth out price action over time. Moving averages mean that you're taking the average closing price of an asset for X number of periods, just like any other indicator. A moving average indicator is used to help forecast future prices. By looking at the slope of the moving average, you can better determine the potential direction of market price. So more on that later. Another thing we discussed in part 2 was the MACD, which stands for moving average, convergence, and divergence. It's usually one of the first indicators learned by new traders, and in many cases, it's one of the first oscillators that traders will apply to their charts. It's also very common for those same traders to give up on MACD and stop using it, claiming that it doesn't work. It is true that MACD does not always work, but this is partially due to improper usage. The MACD is a very logical indicator. It does exactly what the name says. It measures the spatial relationship of 2 exponential moving averages. What is an exponential moving average? A simple moving average will take the average closing price for X number of periods for an asset. So for example, if you use a 200 period simple moving average, it will calculate the most recent period to be equal to, say, that of 195 periods ago. So this can be a very lagging indicator and give us information too late. So that is why exponential moving averages are very popular for technical analysts, because exponential moving averages are calculated to put more weight on the more recent periods in an attempt to make EMA values more relevant and in time with the market. So the most common inputs for MACD are using EMAs of 12 and 26, along with the signal line of 9 periods. Let's see what we can find here in our MACD charts. All right, so here's the MACD. You see the green line. It's also known as the MACD line. It's the faster line and responds more abruptly to price change. And this line represents the difference between the 12 and the 26 period moving average. Then we have the blue line. It's known as the signal line. It's the slower moving line that plots the average of the previous MACD line. This smoothens out the original line even more, which gives us a more accurate line. So, and then we have these red bars, known as the histogram. The histogram simply plots the difference between the fast and slow moving averages. So you'll see that when the 2 moving averages move away from each other, we see that the histogram gets bigger. And this is what we call divergence. The moving averages are diverging from one another. We see that also here. As the moving averages diverge from one another, the histogram gets bigger. Okay? And as moving averages come closer together, the histogram gets smaller. This is called convergence because the faster moving average is converging or getting closer to the slower moving average, and this is where the name MACD comes from. Moving average convergence divergence. So how do we use the MACD? So since there are two moving averages moving at different speeds, the faster one will obviously be quicker to react to price movement than the slower one. And when a new trend occurs, the fast line will react first and eventually cross the slower line. When this crossover occurs and the fast line starts to diverge or move away from the slower line, it often indicates that a new trend has formed. So let's just bring up a picture here. So in this picture, you'll see the fast blue line cross under the slow red line. Okay, where is that? Right here. And the histogram temporarily disappears right here, okay, when the fast blue line crosses over the red line. This is because the difference between the lines at that time is 0 at the time of the crossover. And as the downtrend begins and the fast line diverges away from the slow line, the histogram gets bigger, which is a good indication for a strong trend. So in this image, the fast line crossed above the slow line while the histogram disappeared. This would suggest that the brief downtrend would eventually reverse. And after that, we do see the Euro USD start to shoot on up, start a new uptrend. Okay, so let's see right now on our charts. Maybe we have a good signal to give to you guys using the MACD. And we'll be looking for crossovers. So we missed this one over here. We got the signal from the MACD right here telling us to take a put position, and the price did fall thereafter. So let's see if we can spot any other crossovers using the MACD. Don't worry if we don't. We have other strategies to cover today. Okay, so just one moment here. Okay, so we're a little late for these crossovers. They have taken place already. We see, oh, sorry, one moment. Saw a crossover happen right here, and the price increased thereafter. That's what we're trying to spot right now is a crossover. Hopefully I can give you guys a nice trade. Just a moment here while I look for examples. And just another minute. I did receive a message from someone saying that they can't hear me. Can someone please write in the question box just confirming that I can be heard so I know that everything is working? Yes, all good. Thank you, Carl. All right, so let's continue. All right, so I'm looking here for signal. Maybe we have one right here. Okay, see this signal, we've already missed it. It would be a little risky to take right now. But what about this gold? Also, I think we missed it. So we might not have a MACD opportunity. I don't want to force it with you guys. If it's there, I'll give it to you. And if not, next we're talking about Bollinger Bands real quick, and then we're going to move on to the new topic, stochastics. And we actually do have an indication here that this is fresh cross on the USD JPY. So we could take an hour trade using this 15-minute chart. This is telling us that see the green line is crossing below the blue line, so it's telling us to take a put position for an hour. So I'm going to go ahead and place that trade on the regular platform. USD JPY. And take a $2,000 put on that position. Hit apply. All right, let's see if we can find something else. We'll come back to the MACD just in case something does show itself. And I said we were going to Bollinger Bands next, but actually I want to just briefly cover the exponential moving average strategy that we use for trade of the day. And we might not have time for Bollinger Bands because I really want to show you this new strategy. So quickly on exponential moving averages, let's go back over to these charts. So we mentioned earlier, moving averages display the average price for a selected period, and exponential moving averages place more weight on the more recent periods in an attempt to remove the lag associated with traditional SMAs, simple moving averages. So in each of these charts, we have 3 exponential moving averages, and maybe you guys are following our trades of the day, which we still have a very high success rate of. So each of these charts has 3 exponential moving averages. A 200 period in the light blue, a 12 period in the red, and a 26 period in the dark blue. So the first thing we want to determine is exactly where is the trend heading, and that is told, by this light blue line. Now, if we see the price above this light blue line, then it's indicating to us a bullish trend. However, if we see the price below this light blue line, it's indicating to us a bearish trend. Okay, so let's see if we can find a good example here for trading. Let's look at some other charts, because after I find the price either above or below the blue, okay, for instance here in the Euro CHF, we have the price below the 200 period moving average telling us that the trend is bearish, and the next thing we would look for is for the red line to cross below the dark blue line, which would tell us that price action is about to turn back in the direction of the trend. And it's possible that we don't have opportunities right now, right this second, so let's go ahead and look back at a couple that we have already done. So, for instance, on February 14th, we took a gold call. So let's go take a look at gold. The 14th, in the morning, this is probably around the time that I saw the cross. No. Yeah, it was right around here. We saw the price above the light blue line. Let me make this bigger for you guys. So after that, we wanted to see the red line cross above the blue line, and that was around here, and that's where we took our trades. And those trades were in the money for us. And maybe just one more example. For instance, our very first one on January 18th, Euro CAD call. Actually, since I'm on this screen, let's look at silver that we took on February 6th. Silver call, February 6th. Let's see why we took that. Okay. February 6th in the morning. Interesting. I'm not seeing the signal now. Maybe I was looking at a half-hour chart. Well, for some reason I can't spot that signal right now, but that trade was also a winner, as is the majority of our trades of the day thus far. So I don't think we're going to have enough time to go back and talk about Bollinger Bands. So those of you who have questions about Bollinger Bands, at the end of this webinar I'll give you my email address, and you can start to email me some questions, because I'm not sure that we'll have time for a Q&A today. Let's see, I'm trying to, Bollinger Bands might take too much time for us. So today we're going to be introducing the stochastic oscillator. It's a technical indicator that dates back to the late 1950s. Let's see what we have here in Figure 8, the stochastics. Okay, and so dates back to the late 1950s and has stood the test of time. It was developed by George C. Lane. The stochastic oscillator is based on the observation that as price increases, closing prices tend to be closer to the upper end of the price range. In downtrends, the closing price tends to be near the lower end of the range. Stochastic oscillator is made up of two lines oscillating at a range of 0 to 100, and the K shows us the ratio of differences between current close and lower price, and between highest and lowest prices is the main line. The second line is the D. D line being a moving average of K over a chosen period. So like the RSI, stochastics help us determine overbought and oversold conditions in the market. The indicator is made up of two lines that are similar to the MACD lines in the sense that one line is faster than the other. Also, like RSI, the stochastics are scaled from 0 to 100. With RSI, we watched for two particular numbers. We were watching for 30 and 70. But for stochastics, we're going to be watching for 80 and 20. So we will call between 20 and 80 the danger zone and wait for opportunities outside of the danger zone. So when the stochastic lines are above 80, it means that the market is overbought. And as a rule of thumb, we take put positions when the market is overbought. And when both lines are above the 80, it shows that the market has been overbought for such an amount of time that a reversal is bound to happen. So the strategy we're going to talk about today will require waiting for the lines to cross while outside of the danger zone. This is going to be a very short-term strategy. We're going to be using the 60-minute tab. And today, I'm glad you guys have signed up for NetDanya, but today I'm also going to recommend to you TradingView. Okay, TradingView.com. You're going to have to sign up for an account. It's also free. And this charting software actually pairs very nicely with our 60-second chart. So we don't have ideal conditions for trading right now because there are some economic events happening, but I'm going to try to do this strategy with you anyway. So when you are in TradingView and you do select your asset, be sure that you're on a 1-minute chart. And if you want to add the stochastics, you come over here to Indicators and add the stochastics. Just click it and it adds. So now I have two stochastics, and this is the one I had before. You'll notice that the default settings are 14, 3, and 1. Now we're going to change those for this strategy to 8, 3, and 3. How do we do that? We come here over here to Format, change it to 8, 3, and 3. Okay? So I don't need two of these. I'm going to get rid of one. All right, so we can see the danger zone is clearly marked using this TradingView, which is one of the reasons I am recommending it to you folks. And be sure that on the 60-second platform we have selected 300, and be ready to trade the lowest amount. So for this strategy, to do it safely, for regular accounts, you're going to need around $11,000 in the account. That's because we're going to be combining this strategy with the martingale, which means we're going to be taking bigger and bigger positions to hedge potential losses. So for a regular account, we would want to have 10,935, and for a VIP account, you would need 54,675 to safely do the strategy. I'm going to be using a VIP account. So for those of you following along with regular account, when I take a $25 trade, that means you take a $5 trade. When I take a $50 trade, that means you take a 10. 150 is 30, 450, 90, and so on. And so let's begin, and I'll see if I can continue explaining it as we go, because it will involve some waiting and possibly some silence as we wait. So right now, we see the lines are in the danger zone. So let's move on to a different asset. Okay, so we have the lines outside the danger zone here, but we want to see them cross. So let's continue looking for a better opportunity. And you can see that the lines are inside the danger zone, so we don't want to trade that asset. Lines are breaching the safe zone. We'll wait on that. Nope. We have one of our lines inside the danger zone here. Not going to work for us. So I'm just cycling through our available assets to find an opportunity. And we have a cross here. However, I feel like we might have missed this opportunity. Let's see if we can find something better. USD CAD, no. USD, because you guys can see that it's still inside the danger zone. I'm looking for an example with, okay, like this one with the lines outside of the danger zone, and you see we have a cross here. It's telling us that the price is overextended in one direction, and it's bound to drop soon. So what we would do is come over to our platform and make sure we're on USD CHF. Make sure you're using the bottom so we can view open positions. So USD CHF, right now, it's telling us to take a put position. And let's start at the lowest. So for you using VIP, it's going to be 25, and regular will be 5. Okay, so we'll approve that, and that we're going to get our 50 ready to trade. What we're doing is we're waiting for that reversal, and while we wait, and it might take more than 300 seconds or 5 minutes, so in that case, we're getting ready to hedge a position with a bigger trade that will more than cover the losses. So right now, I'm just going to keep track of what we're doing. And so we have entered so far a $25 trade. We'll keep track of what's happening. So far we're in the green. Now, if it does turn into the red, what we would do is we would want to wait, see at least 5 pips difference from our previous strike rate to the current rate. So we're just teetering here on and off. We're 4, 3, 2 pips. We're not far enough. Okay, so well, actually, I mean, it's in the green, so there's no need to take another trade when it's in the green. We're merely waiting, and if we need to cover that trade with a bigger trade, then that is what we will do. But remember that we have time here, so let's not burn ourselves out too quickly. Okay, so we do have some strong upward momentum, but the stochastics do tell us that that momentum should cease. Okay, so I'm going to hedge this with a bigger position now because I have more than 5 pips. So we're going to take another put position. Make sure you're on the 50 this time. Just keep track of that. And now we play the waiting game. It is possible that both trades go out of the money. If the 50 goes out of the money, we use the 150 to cover it. If the 150 goes up out of the money, we use the 450 and so on. That's why all of these amounts are specially designed for this particular strategy. And we're having a good showing right now, seeing green instead of red, so we could possibly win both trades, and I will wait with you guys to see if we do. And once we finish this strategy, it will be the end of our session, and we'll see if we do happen to have enough time for a Q&A. So just wait with me, and let's watch to see what happens. And that position we took before, I can see someone has asked, it was in fact a put position. It is in fact in the red right now. However, you'll notice that our trade of the day is very, well, not so deep in the money, but it is winning. So for those of you who are following our trade of the day, it's definitely worth your while. So back to our 60-second platform. We are still in the green here. And coming back to our charts, you know, we do see the price falling a bit. We're still outside of the danger zone. What we're hoping for now is for the stochastics to come back into the danger zone, which would also be shown here by the price falling. And, you know, that would give us a little more safety, but we do have plenty of safety here as long as these amounts are added, when added up, are in your account balance. So this first trade might actually lose for us, but let's wait and find out. We still have plenty of time, and as long as my bigger trade is in the green, we have an overall win. Now, this strategy is great for those of you out there. A lot of you have bonuses in your account, and in order to claim those bonuses, you need to complete a certain amount of trading volume. And this strategy can certainly help you get there quickly. So let's continue. We could see some profits here within the next 126 seconds. And if you see what's happening here, we're sitting a little pretty right now. We just gained 40 pips in our favor. Okay, so the stochastic oscillator definitely came through for us right now. I don't want to speak too soon. Looks like this trade's about to expire. Let's see what happens. Our next candle here is green, so we're not in the safe zone yet. But let's see, validating for a $44 potential payout. Just another minute here. It's a very busy. Okay, so we won that trade. Let's keep track of what's going on here. So for a 25, we've received 44 back. And until we win this trade, we're still down $31. Let's see what happens in the next 73 seconds. The price is falling still, and we are a good 40, 50 pips in the money. So I'm feeling pretty good about this one. But nonetheless, we have another minute. Anything can happen in this minute. And I hope it's clear to you guys. What we're looking for is for these two lines to be outside of the danger zone. That's either below 20 or above 80. When it is below 20, it means the downtrend is likely to end and reverse upwards, so you would take a call position once you saw the lines cross. Or when the lines are above the danger zone, it means that the market is likely to reverse back downwards, and when these lines cross, we would take a put position. Just a reminder. We're almost done here, just another half minute. And you know, anything can go wrong in a half minute, but we do look very good. So I will end it there if we do place in the money. Just another 10 seconds to go. I know your hearts are beating. Let's see what happens here. All right. Let's let it validate for a potential $88 payout. And we won that. So let's see what happens. Let's add that $88 here. In a matter of 10 minutes, or even less, we just made $57 profit. So great job to you guys. Little round of applause there. Now, I hope you guys can take this strategy with you. You can use it at any time throughout the day once you find you know, your stochastics outside of the danger zone. Now, this strategy is best done with two screens. You can see I'm a little smushed here, and that's because the webinar can only take place on one screen. So I'm gonna see, maybe I have a couple minutes for questions. I'm gonna see if I can get some questions answered right here. I hope the strategy is clear. Real quickly, for those of you not going to stick around for the Q&A, if you do have any questions or concerns, please, here is my email address. Shoot me an email. And if some of you are tuning out right now, I want to thank you for joining us today, and I hope you're going to come back to join us next week when we talk about the ADX. We're going to build off the RSI strategy that we learned and add another indicator to it, the ADX, and combine the two to see if we can strengthen our signals. So someone asked for RSI. We're waiting for the RSI to dip below 30 or above 70. And Pat, for this particular strategy with the stochastics, yes, we are using always 300 seconds. Let me see if I can show you how to set the stochastics on that chart one more time. All right, so you have your chart here. You click indicators and find stochastic. And remember that the default is 4, 3, and 1. We want to change that for this strategy. You click format, the format button right here. Change it to 8, 3, and 3. Sorry, 3, 8, 3, 3. Okay. So a quick recap of the stochastic is, let me just get rid of one of them, is we wait for the stochastics, like here, to come outside of the danger zone and take a cross. We might see a cross here. I don't have enough time in this webinar to start the trading strategy over again, but if this was to cross down here, and when it does, it certainly will after this strong down period of a downtrend, it's telling you to take a call position. So on the charts, on the platform, make sure you're on the 300. Make sure you select the right asset. And if you're below the danger zone, we're taking a call. Above the danger zone is a put. And, today we started with the smaller amounts and still made $57 in a matter of minutes. So just take a second to imagine what you can do in a matter of minutes if you were to use the bigger amounts. You just have to make sure that you have enough in your account to cover the difference. All right, so I can see that there aren't any questions out there, but there are plenty of attendees still here, so that must mean that you guys understand the topics I discussed today, and I'm very happy and pleased if that is the case. So I'm going to call an end to it here. Once again, if you didn't get your question answered, I apologize. Please email it to me at josephgo@plusoption.com, and I'll get to it as hastily as I can. My inbox is quite full of time, so I do apologize if it does take me some time to respond. So once again, within the next day or two, you should receive in your emails a link to our next webinar, which is going to be Thursday at the same time, 15 GMT. Like I said, we're going to build off our RSI strategy and add an ADX to it. So thank you, everyone, for joining me here today. It was a pleasure doing this with all of you, so have a great weekend. I hope to see you all back next week. Bye now.